Hi everyone. This is my second take of the European markets. So I'm just doing a small update here. Now, about 30 minutes after the US market opened, and it's I'm on the weekly chart, and right now I'm on the Italian uh, index, and it's been an absolute monster move this week. So already this week we're about 12% down. Massive price action movement with the ascending triangle, as you can see here. So right now we're hitting quite key levels, especially on the higher time frames, like the weekly and the monthly. Most of that is because of the Russia-Ukraine news. The war has escalated once again with the nuclear plant um, being attacked and under control of Russian forces. I think now markets are slowly beginning to sink into markets. The fact that growth is eroded, any form of growth coming out of the pandemic is being completely eroded by higher energy prices, is particularly when we look at the German market as well. That heavy reliance on Russian gas. And now with sanctions on Russian exports, we're going to begin to see prices rally. The only alternative for oil is Norway and Great Britain, and shipping oil from the Middle East. And to be honest, it's incredible to see whether it'll be sustainable for many markets without having some form of central bank intervention or of monetary policy or fiscal policy already. WTI oil today is at 112, and Brent crude is at 114. Hit a high of 119, 120. Not too sure. I feel like it's hit 120. And WTI hit 116. And you can see we're hitting some of the highest levels since 2008. 2008 WTI hit 147, 160, 146. And natural gas up 3% today. You can have a look at the CBR equities, and already coming out of the pandemic, we had quite a steady rally. As you can see, more demand, the reopenings, some pullbacks when we had certain countries go into lockdown again, but really just full steam ahead. You can see here there was some anticipation of what will happen next at the higher level, the channel. And then once Russia invaded, it's been on an absolute tear. And if you zoom out a bit further, you can see this descending triangle, almost on a much larger time frame, just picture perfect. And for me, there's a possibility with this war and disruption to grain prices, coupled with disruption to energy prices within Europe, that we could certainly hit 2011 highs on the commodity index. Perhaps it would really take another major event on the macro level to hit the highs of 2008. But I can see this rally continuing for a few weeks, and once again eating into any forecasted growth for global equities. Back into the European indexes, we can see today the UK FTSE was down. How much? Let me just measure it here. Yeah, right now it's down 7% was down 7% for the week. You can see it's touched off that trend line from the March lows of March 2020. So is that quite a key indication level? I think depending on how US markets close today, we could close the FTSE below this line or just at the bottom, and then next week gap down based on what happens over the weekend in Russia and Ukraine. Are they able to find some kind of resolution with peace talks or not? So curious to see how that turns out. Let's have a look at the Dutch AX. Dutch AX, broke a key level. If you look on the monthly time frame, all the way from 2008, there's been a strong rally, and then after the reopening, after the first pandemic wave, and then with the discovery of the vaccine from November, it has just been steadily increasing until news or rumors of quantitative tightening from the Fed began around last year, November, December. Now it has broken down this key support level at 708 euros. So yeah, I can personally see the Dutch AX continuing all the way down to 630 levels, really depending on how this Russia-Ukraine situation pans out. I think with a lot of the European stocks following a similar trajectory. Only one that is not following the trajectory as much is this ETF that I follow, the Nordic ETF. And I think this Norway ETF really has to do with the fact that Norway is the second largest producer of oil in Europe, and because they're one of the only other alternatives, it's going to be really hard to see how their economy is going to decline. So I feel like a lot of the Norwegian energy stocks kind of propping up the market because out of the other countries in Europe, they are going to benefit significantly from this scenario. That's the situation with Russia and Ukraine. So Euro Stock 50 also really breaking through key levels here. Like it's incredible, like just smashing straight through the pandemic support levels. And especially considering it's a Friday, if we close this week below these levels, you could see major gap downs. And I feel like a lot of this has become from the fact that we don't know how exposed European banks are to this Russia fallout. If you can imagine, a ton of Russian assets have been downgraded. They're going to have to balance the books, which means they have to sell equities to make sure that things are balanced on their balance sheet as an individual bank. If I have a look at, for example, some of the Dutch financial stocks, if I scroll down a bit, so if you're going to take example of ING, massive gap down this week, the start of this week. I think from their most recent highs, they're down about 35%, and still breaking through levels. I feel like we could over the next week hit 8.3 euros. If we have a look at Aegon, another insurance company, this upward trend from the reopening after COVID, again, massive hits. We are still not sure yet, and it solidified this trend channel break. National Nederland, again, it's a picture perfect price action of the ascending triangle, where it's just cut through like a hot knife through butter these support levels. And yeah, I think if we scroll back up to see a few other European banks, HSBC also taking quite a bit of a dive. Santander, not as much. Barclays, a little bit, but I feel like some of these, again, this upward trend is broken on Barclays. US banks, Morgan Stanley and Goldman Sachs, while they are down, and that's probably to do more with the Fed tightening, yeah, they're not as far down as some of the European banks today. So if we have a look at some of the Chinese stocks, Alibaba, still continuing this trend downward. JD, Baidu. Some of the Chinese tech stocks are starting to stabilize a bit. Weibo, again, still going down, and that's because of the regulatory crackdown in China. So to be honest, I mean, I'm keeping an eye on Chinese stocks, but I'm not buying for a while. Scrolling down, let's see what else we want to have a look at. Energy stocks. XLE, the energy sector, is right now the only one that's doing well. And I think that's for a very good reason. Again, massive run up, as you can see here. Just complete tear. I feel once we start to see XLE hitting 80, could we see major pullbacks? But right now, the macro factors are not hinting at any major pullback unless Iran sanctions are released, and then Iran can start to export more oil to supplement for the oil that's been lost via Russia. It's tough to see any let up on energy, and that price squeeze is going to continue for a while. Let's have a look at some of the soft commodities. So probably if you've seen the news today, wheat, yeah, incredible levels. I mean, right now the next resistant level is from 2008, and I can see it surpassing 2008 as more information comes out regarding Russia and Ukraine. And as the further we go into the planting season of wheat, the more disruption we see. The more we can see that this has a knock-on effect into the next harvest next year, or perhaps later on this year. So I can't see wheat slowing down, considering just how much wheat is exported from Russia. We're gonna see a lot of commodity prices continue on this trajectory. I don't have the ammonia chart up, but we know that Russia is one of the biggest exporters of ammonia, which is used for fertilizer, and which is again used to grow crops. So we have this vicious cycle of chemicals that are needed to grow crops, and also growing crops, and the fact that this land that Russia and Ukraine is on, it has extremely fertile soil, which is why it is known as the breadbasket of Europe. And right now, the breadbasket of Europe is under attack. So it's hard to see this going down, unless there really is some aggressive monetary fiscal policy that is to reduce spending, to reduce the demand level. Because right now, the supply and the supply chain is heavily disrupted. Silver still marching up. We can see it's starting to complete this cup and handle pattern. The bull flag has also started to increase as well. Scrolling down for gold. If you zoom out on gold, it is a picture perfect cup and handle pattern. You have the cup handle between the highs of 2011 to 2020, and then you've had this consolidation period where we weren't really sure where we're going as metal markets, and then once again with this uncertainty just skyrocketing. So I think gold has held its position as a safe haven. Yeah, it continues to prove a lot of people wrong despite Bitcoin. If you want to have a look at the Bitcoin chart, Bitcoin once again moving in step with equities. There was a bit of a rally last week, I think, because with the crackdown in Russia, a lot of people wanted to put their money into a safe haven, even though the Russian central bank was offering 20% on bonds. But yeah, it's hard to see that people are going to invest their money in Russia. Russia is uninvestable at the moment. Yeah, but I personally feel like we could continue to see another movement down for Bitcoin. Sorry to the Bitcoin holders, but I mean, these are some really key buy zones. And I feel like in these buy zones, you can start to accumulate for the next halvening, because there's clearly a reason why each halvening we see a dramatic increase in Bitcoin. And I think that's just because it plays into the supply demand structure. So if you're a long-term Bitcoin investor, I mean, if you're looking to 2025 to 2027, just buy at these levels and hold. It's not really a structured stream today, but I mean, incredible levels on the yield curve, as you can see here, the 10-year minus the 2-year yield, and yeah, we are screaming back towards these yield levels, and we know that when this inversion is likely to happen, as more and more people begin to put their money into the 10-year bonds, lowering that 10-year yield, and then again squeezing that gap between the 10-year and the 2-year bond. So a lot of surprises, and again, it really depends on how this situation in Russia and Ukraine turns out. All right, that's it from me. Ciao.